Hi there, I'm Sup Day. I'm a chartered accountant and I'm hoping to do some tutorials in financial accounting and reporting, and this might help students who are sitting for accounting examinations. Right, in this tutorial we'll be looking at the balance sheet. In particular, we will explain the key elements in an entity's balance sheet, the criteria for the recognition and measurement of assets and liabilities, the format or presentation of the balance sheet, and finally we'll test our knowledge on the classification of assets, liabilities and equity. Right, a balance sheet is also called a statement of financial position. What information does a balance sheet provide? It is a snapshot of an entity's financial position at a point of time. It shows the total assets of the entity, total liabilities of the entity, and finally the total shareholders' equity. If you look at the diagram opposite, you'll find that there are three big boxes. One, for example, the blue box, is the total assets. And there are two claims against an entity's assets. One is the entity's creditors, which are sometimes referred to as the liabilities of the entity. And finally, the ordinary shareholders' equity. And this is what, if you like, the owners of the company, who are the shareholders, have actually contributed to the company. I will use Superdry PLC's 2020 balance sheet to illustrate the recognition, measurement and presentation of assets, liabilities and shareholders' equity in the balance sheet. You can download from the internet the company's annual accounts ending 30th April 20 and even earlier reports. Well, we're going to start off with a company called Superdry Group PLC. The word PLC stands for Public Limited Company. The ordinary shares of companies with the prefix PLC can be bought and sold in the London Stock Exchange. Now, to interpret or to identify or perhaps understand the data in the financial statements, it is important that we understand what that company's business model is or how it makes money. And this is what Superdry says. We design, produce and sell premium branded apparel to a global marketplace, adopting a flexible, capital-light, multi-channel approach to markets means we are able to evolve quickly to maximize opportunity. The word capital-light here means that it outsources the manufacture of apparel to third parties. Multi-channel approach means they sell on physical shops, they sell online and through social media, franchises and wholesalers. Finally, Superdry is a global company as it operates in 61 countries, in 241 stores and 44 international websites. In this slide, we look at the recognition criteria of a financial transaction as an asset, liability or equity. The key principle in accounting of recognition of an item in a balance sheet is based on the substance over form argument rather than its legal form. For example, leased assets are treated as assets in a lessee's balance sheet even though the lessee does not own the asset. So what's the criteria? Number one, it's a resource controlled by the entity as a result of past event, from which future economic benefits are expected to flow to the entity. And three, the item has a cost of value that can be measured with reliability. Assets, presentation and measurement. All assets are classified into two categories: non-current assets, assets held more than 12 months, current assets, assets held for less than 12 months or its conversion cycle. Conversion cycle is the time it takes to convert inputs into finished goods, and say for example builders who build houses, sometimes their cycle can take anything more than 12 months. Non-current assets are classified into two categories: tangible assets, and these are assets which have physical attributes, for example property, plant and equipment, and right-to-use assets. Measurement: entities can choose between the cost model or the revaluation model when quantifying an asset's value. Superdry plc has chosen the cost model, and the carrying value for PPE in 2020 of 41.7 million represents the cost of purchase less accumulated depreciation and impairment. Impairment arises when the carrying value is greater than the recoverable amount. Right-to-use asset refers to leased assets. These are initially capitalized based on the present value of the future lease payments and depreciated over the lease period. Recognition principle is based on control rather than ownership. Non-current assets. Intangible assets. No physical substance but have value to the business, for example purchase goodwill, websites, software, trademarks. These are all examples of intangible assets. In the case of Superdrug, it has what is an intangible asset here is deferred income tax assets, and these are unused tax losses which can be offset against future profits. Another is derivative financial instruments, and these, the gain at balance sheet date on forward exchange contracts. In other words, the company has at 31st or 30th of April shown a gain on these exchange contracts. Now we look at current assets. They are assets that will be converted to cash in the next 12 months or realized in the normal course of the operating cycle, which can be longer than 12 months. They're presented in the order of liquidity. Inventory, which is illiquid, is at the top, and cash at bank balances, which is more liquid, at the bottom of the current asset list. Inventories are valued at the lower of cost and net realizable value, and the inventory value of 158.7 million in 2020 is after provisions for write-down of inventory of 6.2 million. Trade and other receivables, again valued at the lower of cost and net realizable value. Net realizable value is after bad debts write-off, in other words, that will not be recovered, and probable credit losses. These are provisions against that not all the debts will be recovered. Derivative financial instruments relate to foreign exchange contracts, and they are stated at their fair value or net realizable value at the balance sheet date. Assets classified as held for sale, where this is where the company has decided to dispose of a business and therefore have reclassified some of the fixed assets into current assets. None in 2020 but 2.4 in 2019. They are valued the lower of the carrying value and the net realizable value less cost to sell. Finally, we got cash and bank balances, which is in 2020 is 307.4 million, represent bank balances with various banks and with an AA3 rating. Liabilities. The criteria for recognition of an item as a liability. 1. There is a present obligation as a result of past event. A liability is a contractual obligation to deliver cash or another financial asset to another entity. A reliable estimate can be made of the amount of the obligation, and it is probable that an outflow of resources embodying economic benefits will be required to settle the obligation. Presentation of liabilities deal with the classification of liabilities in the balance sheet. So you have non-current liabilities, liabilities held for more than 12 months, and in 2020 it was 255.4 million. Current liabilities, liabilities held for less than 12 months, and in 2020 it was 460.4 million. Non-current liabilities measurement. The biggest item there is lease liabilities, 2020 of 240.8 million, and this is the counterpart of the leased assets shown in non-current assets. It represents the net present value of future lease payments at the balance sheet date. Provision for other liabilities. An example of provision is cancellation cost for existing onerous contracts, example leasehold properties. Onerous contracts are contracts where the cost of fulfilling the contract exceeds the benefit expected to be received under the lease. Finally, we have derivative financial instruments measured at fair value at the date of the balance sheet and relate to forward foreign exchange contracts. Current liabilities. These are liabilities that will be paid in the next 12 months. Borrowings in 2020 of 270.7 million. This is the amount owing on the bank overdraft. You should also note that in current assets there was a surplus of cash of 304.7 million. Netting of cash balances where one is positive balance and another is a negative balance is not allowed. Trade and other payables, amounts owing to trade creditors and accrued expenses. Derivative financial instruments relate to forward foreign exchange contracts and they are stated at their fair value at the balance sheet date. Had Superdrug exited these contracts on the balance sheet date, it will make a loss of 2.1 million. Lease liabilities of 8.1 million. These represent the capital element of lease payments payable 12 months after the balance sheet date. Equity is the residual interest in the assets of the entity after deducting all its liabilities. It is also equal to the net assets of the entity. The equity in Superdrug plc at 30th of April 2020 is 112.7 million. This is the difference between the total assets of 828.5 million and the total liabilities of 715.8 million. Ordinary shareholders as owners of Superdrug plc own the residual interest in a company. Alternatively, the residual interest is also equal to the capital contribution made by the shareholders, which is the share capital, and the retained earnings to date, which belongs solely to the ordinary shareholders. In the next slide, we will examine the composition of the equity interest due to the shareholders. Equity, recognition, measurement and presentation. Recognition explains how the various equity balances originated. Measurement represents the monetary value of the original transaction. Presentation as is shown in the balance sheet. Share capital balance of 4.1 million in 2020 represents the authorized, allotted and fully paid 5p shares in the company, equivalent to approximately 81 million shares. Share premium in 2020 of 149.1 million. This reflects the excess of the issue price over its par or nominal value of the ordinary shares, which is 5p. Translation reserve represents currency differences when the financial statements of foreign subsidiaries, not denominated in pound, are consolidated with the financial statements of the parent company, which is denominated in pound, at the balance sheet date to produce a single financial statement. For Superdry, there was a cumulative exchange loss of 5.5 million at 30th of April 2020. Merger reserve. A merger reserve arises when the consideration, if any, and the nominal value of the shares issued during a merger is greater than the fair value of the assets transferred. Retained earnings. These represent past profits that have not been distributed as dividends and against future trading losses can be offset. The reduction in retained earnings from 409.8 million in 2019 to 267 in 2020 is a drop of 34.7% and is due to the fact that the company made a loss in 2020. The published balance sheet format is presented to highlight an entity's net assets and how this figure was arrived at. If you look at the equation, NCA, which is the non-current assets, plus the difference between current assets and current liabilities is equal to the net assets, and that is shown in the bottom of the balance sheet. Where current assets exceed current liabilities, it indicates that the entity can repay its immediate creditors. Where current liabilities exceed current assets, it might indicate that the entity has got liquidity concerns. The equities of business in the business, which is 112.7 million in 2020, also equals the net assets. So finally, the net assets will always equal the equity, and which represents the amount due to the ordinary shareholders, or the difference between total assets and total liabilities. Let's have a review of what we've covered so far. The balance sheet shows the net assets of an entity or its net worth at a particular date. The net assets is also equal to the equity in the business, which belongs to the owners of the company. The key criteria for the recognition of non-current assets is control and not ownership. Hence, the recognition of leased assets as right-to-use assets in the lessee's balance sheet. IAS 16 allows an entity to choose between the cost model or the revaluation model when valuing non-current assets in a balance sheet. This can produce different valuations and therefore affect the value of net assets. The inclusion of provision and future lease payments as liabilities in an entity's balance sheet is based on the definition of a liability as a present obligation as a result of past event. Preference shares do not count as equity unless they are irredeemable and where the payment of preference dividends is discretionary. In all other instances, they are counted as liabilities. The key assumption in the valuation of assets and liabilities in the balance sheet is based on the assumption of the entity as a going concern. This allows the adoption of the cost model in the valuation of non-current assets. Finally, the balance sheet in an annual report is always historical data. Superdrive plc's balance sheet for 30th of April 2020 was published approximately 5 months after its year-end date. Two examples to test your knowledge on the classification of items into assets, liabilities, and equity. You may pause the video and check the solution after you arrive at an answer. Here's the first example. Pause the video here before looking at the solution in the next slide. Here's the second example. Pause the video before checking the answer in the next slide.